Good morning and welcome to Economy and Market on BusinessDay TV, where we give you a comprehensive insight into the economy as well as happenings in the market. We're starting off with some of the business news making the rounds. We're starting off with the CBN holding monetary policy rate at 27%. The benchmark interest rates held at 27%, while the CRR remained unchanged at 45%. The Central Bank of Nigeria, through its Monetary Policy Committee, surprised markets by holding its benchmark interest rate at 27%, maintaining its tight monetary stance to keep inflation on a downward path. The decision announced by the CBN Governor Olayemi Cardoso at the end of the two-day MPC meeting in Abuja, came despite expectations of a rate cut. A BusinessDay poll of 15 economists had projected a 100 basis point reduction following October's inflation slowdown to 16.05%. The MPC also adjusted the policy corridor to plus 50 and minus 450 basis points, a shift from the plus 250 minus 250 adopted in September 2025. Other key tools were left unchanged, including the cash reserve ratio at 45% for deposit money banks, 16% for merchant banks, and a 30% liquidity ratio. Tuesday's decisions follow September's reduction of the MPR to 27% from 27.5%. This is extending a 5-year trend that began in 2020 during the COVID-19 economic support measures. Then we move on to Nigeria's petrol import from Malta has dropped by 60% following the establishment of Dangote Refinery. Nigeria's imports of refined petroleum products from Malta have plunged by 60% in 2024, marking a major shift in the country's fuel supply dynamics as the Dangote Refinery has ramped up production. Trade map data shows that imports dropped to about $818 million this year, down from more than $2.1 billion in 2023, when Malta suddenly became Nigeria's top routing point for petroleum shipment. Industry reports had linked the 2023 spike to blending activities and unusual shipping patterns. But with the 650,000 barrel per day Dangote Refinery now producing diesel, jet fuel, and petrol, analysts say Nigeria is finally replacing imported fuel with domestic output. By early 2025, petrol import bills had already fallen by more than half, with shipping data showing a broader decline in clean product imports. Experts warn, however, that supply risks remain whenever the refinery undergoes maintenance. Meanwhile, Nigeria's crude oil loadings dipped to a 6-month low in October. Then we'll move on to the news of VFD Group's extending its 50.6 billion naira rights issue to December 26. VFD Group has secured approval from Securities and Exchange Commission (SEC) to extend its ongoing 50.7 billion naira rights issue until December 26, 2025. The extension follows a surge in interest from shareholders seeking more time to exercise their right. This is according to a statement from the company. VFD Group says participation has continued to accelerate across retail investors, institutional shareholders, and members of the diaspora, prompting the need for a longer subscription window. Under the offer, eligible shareholders can subscribe to 2 new ordinary shares for every 3 that they hold at a price of 10 naira per share. The company encouraged shareholders who have not subscribed to take advantage of the additional time, noting that the program is central to strengthening its capital base and supporting long-term growth plan. VFD Group added that the SEC approval reflects sustained investor confidence in its performance trajectory and strategic direction. Then, Dangote Refinery is tapping Honeywell International for a $1.4 million barrel per day expansion. The Dangote Group has entered a new strategic partnership with Honeywell International to drive the next phase of expansion at the Dangote Petroleum Refinery. The collaboration will deploy advanced technologies that will help boost the refinery's processing capacity to 1.4 million barrels per day by 2028, marking a major step towards building the world's largest refining complex. Under the arrangement, Honeywell will supply specialized catalyst equipment and process technologies to enable the refinery process a wider range of crude grades while improving product quality and operational reliability. Honeywell's UOP division, already a partner since 2017, will continue providing proprietary refining systems and high-performance equipment. The partnership also extends Dangote's petrochemical ambitions, including plans to scale polypropylene output to 2.4 million metric tons annually using Honeywell's Oliflex technology. The group says it is also extending its fertilizer capacity, targeting a 9 million metric tons of urea annually to meet growing regional demand. After the break, we'll move on to a discussion around the MPC's decision to hold rate at 27%. Stay with us. Welcome back to Economy and Market. We're moving on to the conversation around the Monetary Policy Committee's decision to hold rate at 27%. This is despite inflation being at 16.05%. All of the other tools remain unchanged. The credit reserve ratio, the cash reserve ratio is at 45% unchanged. However, there has been a change in the standing deposit facility. We saw the policy corridor extend. We saw it shift to a plus 40 minus 450 from plus 250 minus 250. Basically, what that means is that banks would no longer be incentivized to lend from the CBN as much as they would like to. On the show this morning to give us more insight into some of what we have here. We have Favour Kenneth, who is a research analyst with Meristem Securities. Good morning, Favour.
Good morning, David.
Yeah, it's very nice to have you on the show. Thank you for joining us this morning.
Thank you for having me.
Yeah, so the question I want to start with is the decision by the CBN to hold rate at 27%. How would you summarize the rationale behind it? Because it was expected, or across board, a lot of people expected that the CBN was going to cut rates, after considering the fact that I've been seeing decelerated levels of inflation from most of this year. What's your thought on it?
Well, yeah, just like you mentioned, we expected a cut from the monetary policy in their last meeting. However, we were surprised. So we expected a cut because there have been several improvements in the macroeconomic environment. Like you mentioned, the disinflation we've been witnessing for several months now. It has been steady, price pressures has been quite reducing, and then we've seen growth in the economy, we've seen stability in the FX environment, we've also seen a little bit of appreciation in the Naira. So all of this kind of solidified our projection for a cut from the MPC. However, at the meeting, we were met with a shocker and they held rates. Looking at the MPC's decision to hold rates, they pointed at the fact that they want to give room for the already lagging impact of the previous rate cut that has been seen in the macroeconomic environment to continue. They mentioned, or they highlighted the fact that, the previous rate cuts, the effect of the previous rate cut is now being seen in the macroeconomic environment, as seen in inflation that has been easing for several consecutive months, and which is now at 16.05%, considering where we're coming from. So the old stance by the Monetary Policy Committee was just to kind of like give room for this improvement to continue, for the impact to continue to be seen. However, when we look at it, we also would like to note that the decision, aside from sustaining the current disinflation in the inflation trend, is also the decision to hold rate is also to like keep the domestic assets quite attractive to foreign investors, to continue to attract capital inflows and foreign portfolio inflows from foreign investors, considering the fact that our rates is still quite elevated compared to the region, the sub-Saharan Africa region, and also the broader global economy, where we've been seeing several rate cuts. So we assume that this decision also is to kind of incentivize foreign inflows as well.
The last part of your response was almost a leader into what I would consider, because I was about to ask that, do you not believe that the decision to hold rates was linked to the CBN's effort at trying to ensure that our money, our debt securities still remain attractive, our bonds, our treasury bills, our treasury instruments still remain attractive to foreign investors, considering the fact that rates are down in most parts of the world and Nigeria is still in double digits. So what's your thoughts? Is that like a bigger factor? Was that like a bigger factor in your own opinion, or majorly the inflation reduction was more the factor?
Okay, I would, I think I believe that the decision to hold rates kind of have a little bit more impact on our attractiveness, like the attractiveness of the domestic asset to foreign investors, because the decision to hold rates comes as a part to keep our assets, the T-bills, the bonds, and other debt securities, for them to remain attractive for foreign investors to keep participating in our market. So now when we look at the performance of our financial accounts, when we look at the capital importation, we'll see that the capital importation, particularly foreign portfolio inflows, has increased significantly when compared to like the previous period in Q1 2024. For example, like FPI increased over 150% in Q1 2025 compared to Q1 2024. And this is like a significant improvement, which we can link to the elevated rates, because at 27%, our rates is very, very much of quite attractive to investors, especially when we compare it to the surrounding economies that they have been having like rate cuts. When we compare it to fellow sub-Saharan African economies that have been having rate cuts, and also when we compare it to like developed economies, they've also been rate cuts. So the decision to hold rate would help support inflows, will help support foreign portfolio inflows, will help support attractiveness to our securities, and this would further support the stability in the foreign exchange market that we've been seeing. It will help sustain liquidity, and also help like accretion in the reserve, that will also give the CBN more leeway to come into the market and intervene as they've been doing.
Okay, so the question I have now is around, now the NPR is high, right? It's good for the CBN to keep our domestic assets quite attractive to foreign portfolio investors. But isn't credit still too expensive for meaningful growth? Is the credit rate not still too, is it not still too high for us to be able to have like meaningful growth in the economy?
Meaningful growth. So yeah, you're correct that the rate is still high, it's still elevated, and what this means is that borrowing cost for businesses is still quite elevated. However, while the decision to hold rates might sustain the high borrowing cost environment for the real sector, the other decision to adjust the asymmetric corridor comes as quite an expansionary stance, in the sense that banks would now want to give out more credits. There will be much or increased credit availability for the real sector, especially seeing that the incentive to keep deposits with or to keep deposit or borrow with the CBN is kind of like reduced. So we might see like increased credit availability, even though rates are still quite elevated. And this is positive. This is a good thing, as business would have more access to credit, and it will also promote like expansionary activities in the real sector. Looking at the growth environment for the economy currently, growth has been strong. We've seen this in the consistent expansionary PMI readings. Like for the most part of the year, we've had like consistent PMI readings at over 50, which connotes expansion in the economy. So this is pointed to the fact that the environment in the domestic economy is quite strong when it comes to growth. And then looking at our GDP figures, we posted like a 4.2% GDP growth in the last quarter in Q2 2025, and this is like the strongest quarter-on-quarter growth for a while now. This all points to the fact that even the fact that rate has been high, there's still expansion in the economy. So now the fact that we now have like a possibility of increased credit in the system, this would, even though the impact would be moderate, it would have a little bit of positive impact and it will support growth. So we still expect, like, we're still quite bullish when it comes to growth, regardless of the elevated rates.
Okay. Thank you for that response. So what conditions do you think that we should look out for when it comes to, I'm talking of inflation trends? What conditions should we look out for? FX stability, say banking sector liquidity. What are some of the conditions that we could look out to that you think would prompt the CBN to start cutting the MPR? Because a lot of people in the real sector have the opinion that, so I would pay homage to some of the things I've heard, that the commercial papers have become a much more cheaper source of financing. Talking about debt securities have become a much more cheaper source of financing because banks and the regular financing have become almost prohibitively too high. And all of this is linked to the fact that MPR is at where it's at. So what are the trends that I think that if we look out for, you think that, okay, when we get to this level, the CBN can probably start to reason cutting rates? What are some of these figures? Some people say when the inflation gets to 15%, that okay, that's when the CBN will be incentivized to cut rates. Do you think so?
Okay, well, I quite agree with that, seeing that the government has a target of 15% for inflation. We're currently at 16.05. For us to get to 15% or even below, this might strengthen a rate cut decision from the MPC. But to take this further, I would like to look at the monthly inflation movements, like monthly price movements. So while we've been seeing like consistent disinflationary trend in headline inflation in an annual basis, there's still a little bit of sticky cost pressures when it comes to month-on-month. We've seen in the last inflation figures, headline inflation for the first time increased. We saw that core inflation held steady after like several declines, and then it was just the food components of the inflation that we are now recording deflation. So I feel like the monthly inflation data is also something the CBN monitors to kind of like support their decision. So when we begin to see consistent disinflationary trend of month-to-month, like price movement in the near term, especially in headline inflation, when we see like a consistent or strong disinflationary trend in the monthly inflation, this will kind of like affirm the fact that okay, the price pressures has been a little bit contained. It will strengthen their decision to cut rates. Also, when we look at the FX environment, yes, we've been seeing stability in the FX environment. The volatility in the exchange rates reduced significantly in 2025, like from about 4.8% in 2024, where we saw like the movement in exchange rates was very, very volatile. It has reduced significantly to 0.5% throughout 2025. So this is like an improvement. However, to take it a step further, I feel like further appreciation rather in the naira will strengthen a rate cut decision from the CBN, saying that it will solidify their belief that okay, maybe the risk towards exchange rate volatility has been a little bit contained. So this is what I think would kind of like support a rate cut decision from the MPC.
Thank you so much, Favour. Thank you for that response. You talked about the fact that you spoke about probably a strengthening of the naira, then when we see like a consistent disinflationary trend month on month, then we'll probably begin to see we begin to see the CBN tread in that direction of cutting rates. One question I have is, I want to go back to our initial question and your initial response, where you spoke about the attractiveness of Nigerian assets to the foreign portfolio investors and how the holding rate is key to having Nigerian assets remain attractive for foreign investors. One question I've always had is, are we not digging into a rabbit hole in a way? We are taking, for example, the CBN is issuing 5-year bonds, 7-year bonds at 17%, 15%, 16%. In previous years at 18%, 19%. Is that not quite too high, considering the fact that this government will not always be in power forever? Is there something that Nigeria is backing on, that we are banking on, and we're saying, okay, we can always consistently pay up to 20% of the interest of this particular amount for this consistent number of years? What do you think? Is it not a bit too much? Should we not have our interest rate down to, let's say, single digits in order to make borrowing at least sustainable for the Nigerian economy?
Okay, so yeah, thank you for that. So when it comes to rates in the debt market, in the fixed income market, rates are quite sticky downwards, and I think we're on the path to getting that lower rates for when it comes to the government. And when we question the ability of the government to pay back, I want to believe that there are structures that are being set. A lot of like reforms are going on rather, to kind of like improve the revenue generating ability of the government, so as to be able to like reduce the deficit. And of course, we're going to see a rate cut soon, even though not now, but we're going to see a rate cut, even though like not in the last meeting, we're going to see a rate cut soon. So the rate environment, particularly on bonds and the rest, would still trend lower. But for now, we'll question the ability of the government to pay back debt. I believe that there is structure. There are structures. For example, the tax reform, which could increase tax revenue and thereby increase general federal revenue. That's one way where the government would be able to make more money to be able to meet like its debt obligation, right? And then more and more structures are being put in place to be able to repay their obligations. So despite the rates still being elevated, I believe rates are trending lower, they'll still go lower, and there are structures that would support government's revenue generating abilities, and they'll be able to kind of like pay back.
Okay, now one last question I have is around how does this rate affect household and businesses? Who does it benefit? Who will bear the hike? Who will bear the cost of rates being this high? Basically, how does it affect down to the common man, the fact that the government has held rate? Because we are talking about holding rates. For people on the street, they probably don't understand the rationale, or they don't even understand what it portends, or they don't understand what we are talking about. The people who work in banking and finance are the ones who probably understand. But how does it affect households and businesses, considering the fact that we're heading into December, where there's a lot of spending? That's the month where a lot of spending happens in the year.
Okay, so when it comes to the elevated interest rates, when it comes to who it affects the most, we'll be looking at the businesses who borrow loans to fund their business operations. So when they borrow from banks, when they borrow from the markets, maybe the debt market in terms of commercial paper, they are borrowing at a high rate. 27% is quite high. So this increases their cost of credit. So when their cost of credit is increased, is like high, their operational cost, their operating expenses is also high. And what this means is that business would try to like adjust prices to maybe quite cover a little bit of their cost to be able to make more, and then be able to cover their costs or the cost that is arising from this elevated interest rates. So when they raise prices, it comes down to the common man, to the final consumers. You are buying at high prices as well. So now, most times, businesses are not able to, both with inflation and with high interest rates, they are not able to adjust their prices as much as they can. And this also affects the business. It's not like they benefit. In this case, you will now be seeing shrinking margins. They don't make as much profit as they do. And then for households, they are now buying things at higher prices, and they tend to, like, their disposable income tend to, like, decrease rather. So this is how it affects the businesses and the households. It's not like there's anybody benefiting significantly from the elevated interest rate environment.
Okay, thank you so much, Favour Kenneth. It's been a pleasure talking to you here on Business Day TV.
Thank you so
We've
much.
learned a lot from you. Thank you so much.
Thank you for having me.
You're welcome. After the break, we return back with market updates from yesterday from the NGX. Stay with us. Welcome back to Economy and Market. It was quite a flat trading day yesterday as we saw the market advance by 0.1%. On the NGX, we saw the Ocean Index hit 143,763 after 4 consecutive days of losses. We saw a break from that bearish pattern and 148 points gained. Year to date, we're now up to 39.68%, and in terms of traded volume, 556.153 million shares traded. In terms of value, 18.7 billion shares traded, with our market cap now at 19.4 trillion naira. Now let's look at the top gainers we have from yesterday. NCR continues now at 45 naira 20 kobo after gaining 9.98%. Ikeja Hotel, that's the owners of Sheraton Hotel Ikeja, up by 9.86% to a share price of 22 naira 85 kobo. Prestige Assurance, 9.56% gain to up to 1 naira 49 kobo. Unicel Interlinked up by 9.49% to close at 86 naira 50 kobo, and Sterling Holdco, the banking group, is up by 8.96% to close at a share price of 7 naira 30 kobo. Union Deconsult was our top loser of the day as it went down by the full 10% to close at a share price of 6 naira 30 kobo. Cavatim Offshore Support down by a full 10% to close at a share price of 4 naira 95 kobo. Suno Assurances down by 4.78% to hit a share price of 4 naira 38 kobo, and Lasako Assurance down 4.58% to close at a share price of 2 naira 50 kobo. AXA Mansard was the last of the top 5 losers of the day, 4.23% to close at a share price of 12 naira 45 kobo. In terms of trading volume, all the top traded stocks in terms of volume were all banking stocks, starting from First Holdco that saw a trading volume of 93.7 million shares in deals worth over 2.9 billion naira. Access Holdings, 81.764 million shares in deals worth over 1.689 billion naira. Fidelity Bank follows, 41.793 million shares in deals worth around 796 million naira. FCMB, 38 million shares in deals worth over 386 million naira, and UBA, 31.951 million shares in deals worth over 1.15 billion. From the Nigerian market, we'll move to the global market. It was a bullish day across the US. Dow Jones Industrial Average up by 1.43% to hit 47,000 points. S&P index also, S&P 500 up by 0.91% to hit 6,765.88 points. Nasdaq Composite up by 0.67% to hit 23,000. In Asia, we saw the Nikkei 225 up by 7 basis points to close at 48,659.52 points. Kospi Index up by 30 basis points. Then Hang Seng Index of Hong Kong up by 69 basis points. It was a bullish day across the global market. In the UK, the FTSE 100 that's the benchmark index of the London Stock Exchange up by 79 basis points. The FTSE 100 is slowly grinding towards the 10,000 mark after hitting the 9,000 mark sometime in May. CAC 40 up by 83 basis points, closed over the 8,000 mark. Then DAX index up by 97 basis points to close at 23,464.63 points. And on the currency side, the Naira has stabilized against the US dollar around the 1,400 mark. Now we closed yesterday at 1,449, against the Euro 1,678, and the British pounds 1,908 Naira to the British pounds. And that's all we can take on economy and market for this morning. Thank you for staying with us. Have a lovely morning.